Behind the geopolitical turmoil, who benefits from the US-Iran conflict? The conflict involving the United States, Israel, and Iran is not simply a regional diplomatic or security issue, but rather a storm that is shaking the global economy. Given the Middle East's strategic position as a major global energy supply route, particularly the Strait of Hormuz, any escalation of tensions will almost certainly trigger economic disruption. However, according to economic law, every crisis always creates winners. Who are the parties that technically benefit from this volatile situation? Energy sector, oil and gas producers. The most obvious direct beneficiaries are companies operating in the upstream oil and gas sector. When the Strait of Hormuz is threatened or disrupted, global oil supplies instantly shrink. Profit mechanism. The law of supply and demand applies. When supply is tight, prices skyrocket. Oil and gas producing companies, such as national and private oil companies in various countries, enjoy significantly higher profit margins as the selling price of their commodities on the global market soars, such as the surge in Brent oil prices, to reach $160 per barrel. Safe haven assets, gold and precious metals. In conditions of war or high uncertainty, investors tend to abandon risky assets such as stocks, especially in emerging markets, and turn to assets considered safe havens. Profit mechanism. Gold is a classic winner in wartime situations. The surge in demand for gold as a safe haven for global capital drives up its price. Investors, financial institutions, and physical gold holders benefit from the appreciation in the asset's value. Supporting sectors, shipping and strategic commodities, war changed global logistics patterns. When certain routes were closed or became too risky, shipping costs rose dramatically. Shipping. Ocean logistics or shipping companies that are able to navigate alternative routes often increase shipping rates, resulting in greater revenue. Fertilizers and metals. Disruptions to energy infrastructure and heavy industry, such as aluminum, have caused prices of other supporting industrial commodities, such as urea fertilizer, to rise due to increased production costs. Issuers in this sector are often considered profitable due to global commodity price sentiment. Geopolitical perspective. Shifting power politically. This conflict creates opportunities for third parties to take positions. Alternative energy exporting countries. Countries that are able to increase oil production to fill the gap left by supply disruptions due to sanctions or route closures will gain market advantages and increased state revenues. Strategic observation opportunity. Some analysts note that major powers, such as China, may use these tensions to monitor U.S. military and foreign policy responses in the Middle East, which could then inform their strategic interests in other regions, such as Taiwan. The dark side. Why are these benefits illegible? It's important to understand that the term benefited here is heavily dependent on short-term perspectives and sector-specific profits. In the broader macroeconomic picture, war actually harms almost everyone. Global inflation. The surge in energy prices, oil and gas, will increase logistics costs, prices of basic necessities, and industrial production costs worldwide. Burden on developing countries, energy. Importing countries, including Indonesia, face double pressures: a worsening trade balance and a weakening local currency against the US dollar. Capital flight to safe assets. Economic uncertainty. Businesses tend to delay expansion and investment due to future uncertainty, which ultimately slows down global economic growth. Conclusion: the US-Iran war created an immediate but destructive redistribution of wealth. The commodities and gold sectors indeed profited from price volatility. However, for the wider public and the global economy, this conflict represents a geopolitical tax paid through higher prices for essential goods, inflation, and slower economic growth. The real winners in a war scenario are not those who profit from commodity prices, but rather those who are able to maintain stability and avoid the losses that arise from the escalation of the conflict. Would you like to delve deeper into how this conflict specifically impacts your investment portfolio or specific currencies? Of course, let's dissect the impact of geopolitical conflicts like this on investment portfolios and currencies, especially in the Indonesian context. Impact on investment portfolio. In situations of war or high tension, your portfolio will typically experience a push-pull effect. Risky assets, stocks, generally experiencing selling pressure, sell-off. Investors tend to withdraw funds from the stock market, especially emerging markets like Indonesia, and shift them to safer instruments. Banking and consumer stocks are typically negatively impacted by sluggish market sentiment. Safe haven asset, gold. This is your anchor. Gold prices typically surge due to high demand from global investors wary of uncertainty. If you own gold, physical or digital ETF, your total portfolio value is typically helped by this increase when other assets decline. Energy and commodity stocks. This is an exception. Issuers operating in the coal, oil, or plantation (CPO) sectors often experience price increases due to soaring global commodity prices. However, this is speculative and highly dependent on how long the conflict lasts. Impact on currency. Rupiah versus US dollar. This is the most crucial part for the Indonesian economy. Safe haven. Strengthening. US dollar. During times of conflict, the US dollar often strengthens sharply against emerging market currencies due to its status as a global reserve currency. Rupiah weakening. The rupiah tends to weaken because foreign investors tend to withdraw capital from the Indonesian market, capital outflow, and return to US dollar assets. Import risk. If the rupiah weakens sharply, Indonesia's import costs, particularly oil and fuel, will become more expensive. This will trigger domestic inflation as logistics costs rise, which could ultimately depress people's purchasing power. Survival strategy. Tips for you. If you are concerned about the impact of this conflict on your personal finances, here are some practical steps you can take. Asset allocation, evaluation. Don't panic and sell all your stocks. If your risk profile is medium to long term, these fluctuations are usually temporary. Make sure you have a cash cushion. Cash is king during volatile markets. Increase safe haven portion. If you haven't already, consider increasing the gold portion of your portfolio to 10–15% as protection against currency and stock volatility. Beware of dollar debts. If you have debts or obligations calculated in US dollars, immediately prepare a reserve fund because the installment burden could increase if the rupiah weakens drastically. Focus on quality. In the stock market, if you want to stay invested, choose companies with strong fundamentals, blue chips, and low debt. These companies are more resilient to economic shocks than smaller, speculative companies. Since you have impacted investment instruments, let's develop a more tactical action plan. To provide the most relevant advice, I need to understand your current portfolio composition so that you can take the right steps without getting caught up in market panic. Let's dissect mitigation steps based on the types of assets you most likely own. 1. If you hold stocks, especially in the energy commodity sector. Strategy. Don't rush into panic selling. Energy stocks are often winners when conflicts escalate as global commodity prices rise. However, this is short-term action. Check whether your issuer is heavily dependent on foreign currency, dollar debt. If so, a weakening rupiah will erode their profit margins. If the issuer has strong fundamentals and is an exporter, dollar-denominated revenue, they could actually be more stable. If you hold gold strategy, maintain your position as portfolio. Insurance action. Don't be tempted to sell gold just because the price has risen slightly. Gold acts as a hedge. If your stocks in your portfolio fall, the rising value of gold will cushion your total portfolio losses from significant losses. If you hold banking consumer stock strategy, this is the sector that is usually most sensitive to macroeconomic sentiment and the weakening of the rupiah. Action. Focus on quality, not price. If a company has a dominant market share, e.g. a large bank, with strong core capital, it tends to be more resilient in the long run than smaller companies.